Hey everyone, welcome back again to another session where we will be continuing to revise through some of the key topics of the performance management paper. So as you can see here, we have the syllabus part C, which is decision making techniques, right? So what all things can we, or what are all the key topics when it comes to this particular syllabus area? Let's get started, shall we? The first topic that we would be looking at is basically relevant cost analysis. Okay folks, so when it comes to relevant cost, what are these? These are basically future incremental cash flows, isn't it? Future incremental cash flows. So whenever a question comes up in the exam, okay folks, for any numbers or any amounts that are there in the particular question, the only thing that you have to think of is this. Is a particular cost occurring as a direct consequence of a decision? If yes, then it's a relevant cost. If not, it is an irrelevant cost. Okay folks, so that's basically the idea. And when it comes to relevant costing, of course, you can't expect these MCQs as well as some section C questions as well, so be mindful about that. And another kind of analysis, I would say, a sub-analysis, right, which we would be learning is basically the CVP analysis as well, right? So what is the CVP analysis all about? Well, this is basically where we learn about the relationship between cost, volume, as well as profit, right? So all three factors, for each of these three factors, like there is a relationship between them, right? And we have to learn a lot of formulas in order to tackle those MCQs in the exam. Okay, folks, what all formulas is important here? Basically, the contribution per unit. What is contribution per unit? Basically, the selling price minus the variable cost, right? And what is contribution by sales ratio? It's basically the percentage of contribution as a percentage of the sales, right? So that's basically the idea. So contribution divided by sales times 100 will give you the contribution, by sales ratio, and then you have the profit formula as well. And what is the profit formula all about? How do you calculate profit exactly? Profit is simply contribution minus fixed cost, right? So sales minus variable cost gives you contribution, and contribution minus fixed cost will give you profit. Simple as that, right? And of course, there's the concept known as limiting factors as well, right? So what is limiting factors all about? These are in relation to the constraints that we have, right? So when we're looking into a manufacturing context, right? Let's say that I'm manufacturing, let's say a pen, right? Let's say a digital pen or something like that, right? So the thing is, when you are doing that particular manufacturing process, there might be some factors that can limit my production quantity. Okay, folks, for example, it could be the annual demand, for example, right? If there's only annual demand for 10,000 units, then does it make sense to manufacture 12,000 units? No, not really, right? Because even if I manufacture 12,000, only 10,000 will be sold, and the 2,000 will just remain in my inventory, right? That's basically it, right? So that's basically the thing, okay, folks? And secondly, could also be things like the raw materials, the amount of labor time that we have, the amount of machine hours, right? All of these things can be considered to be a limiting factor depending upon the situation. Okay, folks. So whenever we are making a decision regarding production, regarding the production plan, etc., the limiting factor is a really important factor which we have to consider as well. And there's also that concept of linear programming which you have to look into as well, right? So within linear programming, what are we saying? We are looking at a context where there are multiple constraints. Okay, folks, when there's more than one limiting factor in the environment, then linear programming is used. And what is the objective of linear programming? It's a technique that is used for profit maximization and then cost minimization. How can I maximize my profit with the minimum cost, or how much quantity of my products should I manufacture? All of these things are looked into when it comes to linear programming. Okay, folks, and remember the simultaneous equations and stuff like that as well. Like even though you won't be required to write all those equations in a section C question, no, that's not required at all. But there can be MCQs where you have to determine, let's say for example, the feasible region, right? So it is important to learn that particular graph as well. And of course, there's the concept of slack and surplus. So what's the idea here? Slack happens when we're not setting our targets based on the capacity that we have. Let's say that we have capacity of, to manufacture 10,000 units, but we're only manufacturing 8,000 units. So are we utilizing our full potential? No, not really, right? That's exactly what's happening in budgetary slack. And secondly, we also have surplus as well. So what's the idea behind surplus? Well, surplus is just the exact opposite, right? When we exceed capacity due to certain aspects that happen in the environment, right? So that's basically the idea. So and another really important concept is basically shadow price, right? So what is shadow price all about? The increase in contribution if we get one additional unit of the scarce resource or bottleneck resource, okay folks, or limiting factor as we call it, right? So that's basically as to what it is. And it's important to know because the interpretation can help you tackle certain theoretical questions in relation to this as well. Okay folks, again, it's not the additional this is basically the price of the additional limiting factor which we are willing to pay. Okay folks, that's basically the idea. So I'll repeat once again, change in contribution as a result of getting one additional unit of limiting factor. Okay folks, that's basically the idea. Now and then we move on to some market-based topics or price-based topics as well, price and demand, right? So, first thing that we learn here is what a perfect market is, right? So, what is a perfect market? Perfect market is a market where the price, the firms are price takers, right? Whatever the price is set by the market is accepted by the firms in that particular market. That's basically the overall idea. And and then there's imperfect markets as well. For imperfect market, like what's the idea? Well, in a perfect market, there would be a huge number of suppliers, right? And which basically means that there's a huge option for the customers to buy from different suppliers as well, right? And they would be, dealing with homogeneous products and stuff like that as well, right? But when it comes to imperfect market, situation has changed. Okay, folks, it's the exact opposite of a perfect market where there may not be that much amount of firms. Okay, folks, for example, the supplier would be it depends on the numbers. If it's a single supplier, then we call it a monopoly. If it's just let's say a few amount of suppliers dealing with similar but not identical products, then it's a monopolistic competition. And then there's oligopoly as well, which is a situation where we have a few number of suppliers who have an understanding with each other, isn't it? So that's basically the idea. Okay, folks. So three categories of markets over here, right? Monopoly, where one individual dominates the market, or one supplier dominates the market, right? So that's basically the idea. Monopolistic competition, where everyone deals with heterogeneous products, as in the products are similar but not identical. Okay, folks, so that's basically the idea. And then oligopoly is where there's only a few amount of suppliers, and therefore the bargaining power of customers is low, right? That's basically the idea, because customers don't have much options, right? That's basically the idea. And then we move on to price elasticity of demand as well. So what's the idea here? The extent of market demand change with price change, as in, if we change the price, what would the impact of demand be? Well, first of all, what is the relationship between price and demand? When price increases, demand decreases, right? So if I make a 10% change in price, what would be the impact in demand? How much would the demand reduce? Would it reduce by 8%? Would it reduce by 15%? Would it reduce by 10% itself, right? So this is basically as to what we look at when it comes to the elasticity of demand, right? And demand can be inelastic demand, elastic demand, very elastic as well as very inelastic demand as well. What's the difference between each of these? Well, in the case of an inelastic demand, price should be increased. Why? Because if we change the price by, let's say, 10%, then the decrease in demand would only be 8% or 5%, which is less than the change in price, right? That's what an inelastic demand means. But if it's elastic demand, then price can significantly affect revenue. For example, if we change the price by 10%, chances are the demand can reduce by 15 or 20% as well, okay, which is more than the proportion change in price, right? That's basically what elastic demand is. Very elastic means overpricing can lead to stockouts, and very inelastic would mean that there are price sensitivity factors to consider as well. Because in a situation where there is very inelastic demand, price is not the important factor. Okay, folks, there will be other factors that the customers look for, like the quality, the services provided by the organization, and all these things, right? That's basically the idea. And then we have the demand equation as well, right? So it's a really important equation to learn, which is P equals A minus BQ. Okay, folks, so that's really important to know. And of course, you also need to learn about the marginal revenue or marginal cost equation as well, which is A minus 2BQ as well, right? And using these two equations, we try to identify the value of A, B, and then the price or the optimum price the optimum price at which the maximum quantity can be sold, etc. Right? So that's basically a really important equation to remember. And when do we maximize profit? We maximize profit when the marginal cost equals marginal revenue. Okay, folks, so remember that. And then we look at some pricing strategies as well, right? So what all pricing strategies do we have here? First of all, we have the full cost plus pricing strategy, where we take the full cost of production, right, or the full cost of manufacturing that particular product plus a profit margin, right? And this full cost includes both variable as well as fixed cost elements as well. And then there's also marginal cost plus pricing. In marginal cost plus pricing, what do? We take the variable cost, right, and add a profit margin to it. Simple as that. Okay, folks, so that's basically the idea. And of course, there is market skimming and price penetration as well. So what's the difference between these two methods? For market skimming, we charge a high price at the launching phase, right, and then gradually reduce it. Take an iPhone as an example, right? Whenever an iPhone is released, the price is like really high, right? But gradually, when new versions are released, the price becomes lower and lower down the line, right? So that's basically the idea. And secondly, there's the market penetration strategy as well, which is the exact opposite of market skimming if you think about it, right? Because initially we're charging a low price to enter the market, and then gradually we increase the price, right? That's basically the idea. Like at early phases like Uber, Swiggy, and all these apps, they started off with this particular strategy itself, because during the early stages they were incurring huge crores and crores of losses, and they were providing heavy discounts. Some of you might remember these people providing, let's say, 5 rides for free in the beginning, and then 60 to 70% discounts on the cab services and stuff like that, right? But now they have gradually started increasing, and to a reasonable rate, I would say. Okay, folks, that's basically the idea. So that's basically as to what market penetration or price penetration is all about. We charge lower price at the beginning and then gradually increase it. And then there's also complementary product pricing as well, which is basically the idea that there would be two related products or complementary products, as we call it. For example, maybe bread and butter, or maybe printers and ink cartridges, right? So products like that. So what happens is we may charge a low price for one product, but for the other we make some profit. So for one we make a loss, and for the other we make a profit. That's basically the idea. Okay, folks. So since these are interrelated, the customers will have to buy both of these products. For example, I can't buy a printer if I'm not planning to buy more and more ink cartridges once it runs out, right? So that's basically the idea. And of course, there's product line pricing as well, which is basically setting a price for a product range on its own rather than one particular individual product. That's basically the idea. And then there's volume discounting as well. For example, if you buy products in bulk, then they'll give you a heavy discount on it. Okay, folks, so that's basically the idea. Moving on to the next pricing strategy, which is price discrimination as well, right? So what's the idea here? Different prices for the same products to different buyers, right? As in, so for different category of buyers, let's say for example the smartphone industry, right? If you look at Samsung phones, like there are phones in different ranges, right? For example, there is the premium segment, where you have the Samsung S25 Ultra and stuff like that, right? And then there's a mid-range phones, M series, F series, etc., A series, right? And then there's a low-budget phones as well, coming under the 10,000 rupees category, or so, right? So that's basically as to what the difference, here is all about, right? So that's what the idea here is. We categorize certain products and provide different prices for different market segments, right? So that's basically the idea. And of course, it can also be, basis the product category or product model. We can also discriminate between regions as well. For example, the iPhones might be expensive in India, but it's a bit more cheaper in the UAE or maybe other regions, right? So that's basically the idea. And then relevant cost pricing is specific to a situation. For example, we looked at relevant cost earlier as well. So the idea here is that we're looking at a situation where we're getting a special order or an ad hoc manufacturing order. In such a case, we have to look into the incremental cost, right? Because relevant costs are basically future incremental cash flows. If there are some costs that occurs by accepting the relevant cost pricing or by accepting that particular order, then we'll have to look into the incremental cost rather than the cost that has already incurred, right? That's basically the idea. So yeah, that's basically as to what relevant cost pricing is all about. And of course, there are a few decisions which we talked about, right, where we look into these relevant costs, differential costs, and stuff like that. For example, the make or buy decision. Like this is a situation where we, where we think as to whether we should buy things in-house from the manufacture things in-house in the organization, or should we buy it externally from an outside supplier, right? That's basically the idea. And then there was, that's basically when we talked about outsourcing, right? So in outsourcing, what do? We use external suppliers for products or services as well, right? So that's basically the idea. As in, we need to manufacture a few goods. However, we may not be profitable for us to manufacture it, or we may not have the time or resources to do it. So what I'm going to do is I'm going to outsource it to another organization, a specialist organization, to do this manufacturing process. That's what outsourcing is all about in this context at the very least, right? And then we have further processing decisions as well. So here we talk about joint products, right? So should we further process a particular joint product at the split off point or not, is what basically the question is here, right? So then again, we look at the incremental cost, right? Incremental cost and revenues, and see whatever is profitable. It's all logical thinking, guys, okay folks? So whatever is profitable, we do that. That's basically the idea, right? So the I would say the key thing to think here is how exactly should we think through it. For example, what are the costs that are involved here? What are the revenues that we will be getting? So we have to understand the options that we have, and then look for which one is more profitable and then select that. That's basically it, okay folks? That's basically the idea. Then there's shutdown decisions as well, as to whether we should shut down certain operations, or should we just stop selling products and services, right? That's basically the idea that is looked upon over here. Simple as that. And then we move on to another key topic, which is basically risk and uncertainty, right? So what is risk and uncertainty all about? So risk is basically when both are in relation to the idea that we can't really predict our future, right? We cannot predict what's going to happen in the future. However, if you think about it, if you think a bit more deeper sense, right? I may know, what I could do or what I may be doing in the next 1 year, or maybe even 1.5 years, right? But if you ask me what I'm going to do in the next 5 years, or maybe even the next 10, 15 years, then, will you have an answer? I don't think so. Okay, folks, I may have a rough idea, but it may not be a concrete answer, right? So that's basically the idea, okay, folks? So, the idea behind risk and uncertainty is simply this. Risk is something to which we can assign a probability over. As in, I can expect to a certain extent that this is going to happen for the next year, or this is going to happen in the next month, next week, etc. Okay. However, when it comes to uncertainty, there's no assigning probabilities here, because we are surely not sure. We are definitely not sure as to what's going to happen in the future, but we can, take decisions based on the information that we currently have, right? So that's basically the idea. And then we talk about risk preferences as well, right? So when it comes to risk preferences, there are 3 categories. First of all, there is risk seekers, right? Who are risk seekers exactly? The people or individuals who always look for the best of the best outcomes, right? They always go for the best. They always, plan on, I would say, achieving the best of the best outcomes. Okay, folks. So that's basically as to what the idea behind the risk seekers are, right? And secondly, we have the risk averse individuals, who's like, hey, I don't really need to take much risk from my end, right? But still, I need the best outcome. So my target is to look for the lower risk alternatives, and then choose the best out of it, right? That's basically the idea. And then we have risk neutral individuals as well, which is basically a balance of risk and return. That's basically it. As in, they're kind of indifferent between whether to take the risk or not, right? If they have to take risk, they will take risk. If not, then not, right? That's basically the risk neutral stand. But yeah, then again, most people, they have to choose between risk averse or risk seeking preferences at one point in their career, in their business, etc. That's basically the idea. And then we also learned about expected values as well, right? So what is expected values all about? So expected values are basically weighted average values for decision outcomes. Okay, folks. So what exactly do weighted average value mean here exactly? Well, basically the idea here is that we look at all of the possible outcomes, right, and assign probability weightings in each of the outcomes, right? That's basically the idea. Okay, folks. So we take each and every different outcome, assign a probability weighting, and then calculate it accordingly, right? Sigma px, that's basically the equation for this, right? Probability multiplied by the outcome value. It could be profit, it could be a contribution, whatever it is, right? And then we sum the total of it. Simple as that, right? That's basically as to what expected values are, to put it very simply. And then moving on to Maximin, Maximax, and Minimax regret rule decisions, right? So what's the idea here? Maximin is basically the idea where we look into the worst possible outcomes and select the best out of it. Okay, folks. So a risk averse individual which would much rather prefer the Maxi-Min approach. Okay, folks. They look at the worst possible outcome and choose the best out of it. And secondly, we have the Maximax decision rule as well. So what is Maximax all about? We choose the maximum possible outcome, right? As in we choose the best of the best outcome, right? That's basically the idea. We look at each decision alternative. Whatever is the best in those, we select that, right? That's basically the idea. Okay, that's what Maximax decision rule is all about. And then there's Minimax regret, right? In Minimax regret, the idea here is to minimize the overall regret that I would have from not choosing the best alternative outcome. Okay, folks. So that's basically what it is by definition. Okay, folks. So it's really important that you guys practice this particular topic, because it may seem easy. I can tell you that it might seem really easy, and it is quite easy as well. But the thing is that at times we forget, how to do the calculations or things calculation-wise. Okay, folks. So it's really important that we, practice some example questions or something like that, which was provided to you, right, in the sessions, right? Practice those once again, and then we should be in a good position. So yeah. And then we talk about decision trees as well, right? So what are decision trees? Basically a pictorial method of showing the decision options and outcomes. Okay, folks. So that's basically the idea here. So basically, when it comes to decision trees, always remember, guys, we start drawing it from the left to right, and then we conduct a rollback analysis from the right to left, right? That's basically the idea. And of course, circles are represented for the EV points, and then the square denotes the decision points as well, right? So that's basically the idea. And what else? Yeah, we also learn about value of perfect and imperfect information. So I'll quickly go through how to do the calculations and everything as well. For perfect information, value of perfect information, what are we looking at here? So we're assuming that whatever information that we've obtained is correct. So on that basis, what would be my expected value? Okay, folks. Well, the first thing that we do is we calculate the expected value normally, right, based on the given data. By looking at the probabilities and everything, right? And secondly, we also assume that what if the given data is true, right? What if all of the information provided is accurate? Then what would the decision be, right? So we consider that particular, I would say, outcome of that particular alternative, and then calculate the expected value accordingly. We deduct the expected value with perfect information, without perfect information, from without perfect information, and this difference is basically your value of perfect information, to put it very simply. So the equation is value of perfect information equals expected value with perfect information minus expected value without perfect information, right? That's basically the idea. And secondly, yet again, we have imperfect information as well. So what's the idea here? expected value of profit with imperfect information minus the expected value of profit without imperfect information. Again, so when it comes to imperfect information, there is yet again multiple probabilities, right? So first of all, we set out certain alternatives, we set out certain probabilities for certain outcomes, and then we think, okay, what if the information is wrong? There could be an 80% chance that it could be wrong, and then there's a 20% chance that it may not be accurate as well, right? So we consider all of these probabilities, right? We multiply each probability and we consider all of the possible outcomes and then calculate the expected value accordingly. Okay, folks, so that's what imperfect information is all about. And again, of course, we can only understand so much with theoretical explanations, right? It's really important that you guys use the numbers here as well. Okay, folks, so do some easy calculations, right? The best way to understand these sort of topics, in a bit more better sense, or an easy way to revise through these topics would be to do some example calculations which you guys have been provided with in your notes, right? And then be ready for that accordingly, right? And then finally we have the sensitivity analysis as well. So what do we learn here? Basically, sensitivity analysis is a technique testing decision options for vulnerabilities to change as well. So we look at the sensitivity aspects of each key variable when it comes to the particular organization's data. Okay, folks, for example, all we are doing here is we are asking ourselves the question, hey, how much can one particular variable, it could be the revenue, it could be the variable cost, it could be the fixed cost, right? How much can each of these variables change to make the profit zero? Okay, folks, how much can each variable change at a time to make the profit zero? This is basically as to what we look for when it comes to a sensitivity analysis. Okay, folks, to put it very simply. So yeah, that's basically the equation as well. Okay, folks, change in that particular variable divided by the profit divided by the key variable. Okay, folks, times 100. That's basically how you calculate sensitivity for each of these, for each of the key variables. And of course, like, why do we do that? How do we interpret these? Well, we're just understanding how much should one variable, or how much can one particular variable change. Okay, folks, that's basically the idea. All right, moving on to simulation models as well, right? So when it comes to simulation model, what's the idea here? Modeling technique for capital investment appraisal decisions. So what's the idea here? So when it comes to sensitivity analysis, right? The idea here is just to look at one variable at a time, right? We just look at one particular variable at a single point of time. However, when it comes to simulation model, we run computer simulations to see what can be the impact on profit, or what can be the impact of things like, let's say, net present value, NPV, or something like that. If multiple variables change at the same time. Okay, folks. So that's the difference between simulation models and sensitivity analysis. In sensitivity analysis, we look at a situation where one variable changes at a point of time, whereas in simulation models, we look at a situation where multiple variables change at the same time. Okay, folks. So that's basically the idea here. So yeah, that's basically as to what the simulation model is all about as well. And that basically completes our discussion for the syllabus part C as well. Of course, if you have any questions, feel free to reach out, and I'll be happy to cater them. And of course, stay tuned for tomorrow, where we will be discussing the next syllabus area, which is part D, budgeting and control. Okay, folks. So till then, this is Vishnu Vijay signing off.